Hello again, we move on with the second part on how to trade with the binary options with the RSI oscillators. And on the first part we explained the standard interpretation. Not there is anything wrong with it, it's a very good interpretation. But it works as long as you are able to identify a range. I gave you some tips on how to identify a range, but the other way to use the oscillator, and especially this RSI, is to trust the RSI or the oscillator more than price. Again, because it considers 14 periods here, 14 candles, it could be monthly candles. Actually, it will go on the bigger time frames as well. So, because it considers 14 candles before plotting a value, it is to be trusted more than price. Because when someone between the two makes a fake move, that someone is usually the price and not the oscillator. That's the whole idea of building oscillators based on the price moves in order to make sure that fake moves are avoided. So, another way to use the RSI is to look for so-called divergences between price and RSI. In plain English, it means find out which one lies. And we want to stay with the oscillator. So the key in that case is to look for the series of lower highs or higher lows to be respected or not. In this case, we have a high, then the market forms what? The market forms another lower high in this case. So we had a high here. We had a high, not this one. We had a high here with the oscillator into the overbought territory. And here we have another high, a lower high. So this series, the price made, lower high here, a high and then a lower high. The same series is respected on the oscillator, a high and then a lower high. So no divergence so far, no one lies. But then we look on the opposite side as well. The market goes and forms what? Forms here a low, and then a lower low. We look at the RSI. Is the RSI repeating the same thing? Yes, it does. So this is a low corresponding to that value, then a lower low. Then the RSI confirms the new lower low that the market made. This is the RSI confirming this low too. But then the market makes a low, the euro-US dollar makes a new low. But if you look at the RSI here doesn't make a new low, actually forms a higher low. This is called a bullish divergence in technical analysis and calls for a reversal. Namely, the price makes two consecutive lower lows and the RSI doesn't confirm the second low. Remember, one of the two lies. Which one is lying in this case? The price always lies because it considers the current price or only one candle, whereas the RSI considers 14 candles in this case. So if we are to have an educated guess, we should go and buy a put option, a call option, by the time that the RSI is not able to go and make a new low. That's the easiest explanation I can give on how to spot a divergence. Then you move forward with the same analysis. Nothing changed. I mean, the market comes and does what? Makes a low in here. Actually makes a low here. Makes a low here. The RSI goes and makes a low as well here. Then the price action, where the euro-US dollar makes a new low, but surprise, surprise, the RSI, the relative strength index, fails to confirm that low. If it fails to confirm that low, this is called a bullish divergence in this case as well. We would like to go and buy call options, of course, having in mind the expiration date. It is that easy, it is that straightforward. There's nothing fancy in this analysis. We only need to pay attention and to make sure that we understand the dynamics behind interpreting an oscillator. What's also important is the following. Try to focus on divergences that form into overbought or oversold territory, like this one here. This one, the second move into the RSI is not below 30. Not that it won't work. In this case, it worked like a charm, but sometimes it doesn't. Or try to avoid divergences that are not in that are in between 30 and 70. Not that they won't work, but they work rare, or let's say not that often, like the other ones. For example, this is where the RSI makes divergence with the price as well. It's a very good place to buy a put option. Nothing wrong with it. Only that it isn't in the overbought territory. So this is how to use a simple RSI interpretation to trade divergences. Now, of course, there's a catch here as well. These divergences form at the end of a trend, but a trend may be so strong and it may stay in a divergence manner more than a trader can stay solvent. But for the binary option industry, that's not quite the problem, because the risk is defined. I mean, you have a trade, then you have an option, you have an expiration date, and it is important what happens not until that expiration date. It is important where the price is at the expiration date. So you might go and trade here a binary option, for example, a put option, and then the market moves to the upside with, let's say here, with end of the day expiration date or end of the week, and the market moves to the upside like this, and then towards the end of the week falls like this. If in the FX trading you will be stopped on this kind of a move, and then you'll only look at market with feeling sorry, in the binary options you don't have that kind of a problem. Such a simple approach. This is the recent 1 hour chart on the Euro US dollar. Such a simple approach end up giving you or offering the possibility to stay on the right side of the market. Thank you for being here, and we'll move on with more interesting concepts here. Bye bye.